want to thank everybody for joining me today. My name is Wesley Boudreau, one of the financial advisors here with the Retirement Group. Today we're going to talk about the Chevron pension plans, a little bit about the claiming strategies you have, and a lot about the lump sum conversion calculation, how interest rates are affecting those right now. Before I get started, just want to remind everybody that the Retirement Group we're not affiliated with, nor are we employed by Chevron. Also, throughout the course of this, there's a couple of buttons on the Zoom screen you can take advantage of. There's going to be a chat box where we will periodically be putting some information in there for you to follow along with. Different items like how to set up a meeting with myself or one of the other Chevron-focused advisors at the Retirement Group, how to follow us on LinkedIn and maybe the specific Chevron page so you can get updated on interest rates as we put those out, and any new webinars that we have coming out as well. Also, if you would like to sign up for the next webinar, whether it be Chevron-specific or generic webinars, we'll have some links in there as well to sign up for those. And at the end of the day, we've been doing quite a few of these. So if there's any questions that or any suggestions for changes that we can look at to make these better, or new topics, just let us know. We'll be happy to address that as well. If you do have any questions, I know a lot of people have been asking a lot of questions here recently with the interest rate changes. But if you have any questions you'd like to address, use the Q&A box, because that is an anonymous box. So if you put a question in there, it'll come through anonymously and your name will not show up. So again, any questions, just feel free to use that, and or you can also reach that 800-900-5867 after this. So before I get started, I just want to remind everybody who maybe hasn't been on one of these webinars in a while or sat down with us, the Retirement Group, again, we are an independent financial advisory firm who focus on working with corporate employees and helping them transition into retirement. We've been doing this for about 30 years. We've been working quite extensively with Chevron employees and retirees for quite some time now as well. The reason we choose a select few companies to work with is it gives us a deeper understanding of your specific benefits plans, whether it be the pension we'll talk about today, the 401k, health savings accounts, retiree medical options, and just everything that can help you transition from an employee to a retiree, and make sure you avoid a lot of common mistakes we see from time to time. And a lot of those mistakes could cost you quite a bit, whether it be focus on Social Security offset and UA calculations, picking the right time to retire for your pension calculation, things like that. If you want to sit down with myself or one of the other advisors, we can still accommodate you face-to-face. We have offices throughout the country, so rest assured we're still good there. But if you want to do business via web meetings or email or chat, phone calls, we can still do that as well. And that's obviously easier right now. And at the end of the day, if there's anything you take us up on, it's that complimentary cash flow analysis we run for you. I know a lot of you have taken us up on that, and even if it's been the last 6 months or a year since you've done it, go ahead and reach back out. It's probably good to update it because a lot has changed with the interest rates and obviously Chevron stock and the stock market as a whole. But if you have not done one of those, give us a call to do so. This is a way for us to kind of help guide you through the transition process and make sure you are ready to retire, and help uncover if you should make any changes to that retirement date, or if you need to increase your savings in the future as well. So we can look at your desired retirement date, run the projection for the pension as a lump sum versus the annuity to see those side by side, how they look not just now, but in 10 or 20 years down the road. We can also look at varying retirement dates to see if you can retire earlier or should work later. If you want to do some part-time work, all those things can go into that plan to show you exactly where you are and if you're on the right path. So getting into the Chevron pension plan now, most of you might be with Chevron, but some of you may have come from some other companies like Caltex, Texaco, Gulf, not Standard, that's a little bit older. But ultimately speaking, there are some differences in a lot of these defined benefit plans, but across the board, it is a defined benefit plan, in which case there is a calculation that's used to determine what your single life annuity is going to be. From there, that's where all the other options are going to play out. And that calculation is going to look at a multiplier times your years of service and your final average pay, and a Social Security offset where they claw back Social Security. So once they figure out what that single life annuity is, that's where the other payment options are going to come from. So you run that calculation. Let's assume that maybe it comes out to $3,000 a month, single life annuity. From there, maybe you want to look at a joint survivor annuity where you want to make sure your spouse is taken care of for the rest of his or her life if you pass away earlier. And that way it's going to be a smaller amount because you're paying off of 2 lives. Maybe you want a period certain, so that way you know that God forbid something happens to me, in the first couple of years or earlier in my retirement, that at least my beneficiaries get a certain amount. So maybe a 5, 10, 15, 20-year period certain. So if you had a 20-year period certain and you passed away, let's say in year 14, there's 6 more years that could be paid out to your beneficiaries. There's also a unique uniform income option where you can actually tie it to Social Security, so you get a larger pension from Chevron initially, and then when Social Security kicks in, it's going to drop down, so that way you have a level amount. So again, going back to that $3,000 example, maybe $3,000 was what your uniform income was, so Chevron's going to give you $3,000 until Social Security kicks in. And then when Social Security kicks in, let's say it's $800 a month, now they're only going to give you $2,200, so you keep that level $3,000 across the board. What we're going to talk about a little bit more today are going to be the interest rates and how they affect that lump sum calculation, because a lot of you have been looking at the lump sum options over the last few years, because we've been in a pretty interesting environment where interest rates have come down thanks to the pandemic, which has driven up the lump sum calculation. So you've seen some of the highest lump sums we've ever seen in the history of Chevron. On the flip side, we're seeing some of the most dramatic swings and decreases in lump sums we've ever seen coming forward here as well. But before I get started with that, the other aspect is how much of my pension am I going to capture or get? And if you want to make sure you get 100% of it, you want to make sure that you make it to age 60 as far as either your retirement date and or your benefit commencement date. So those are different. You can actually retire earlier, let's say at age 55. And if you look at these highlighted here, at age 55, you're only going to get 75% of your pension. But if you were to retire, but instead of collecting that right now, defer that out to age 60, then it will you'll eliminate those age penalties and it'll move up to that 100% level. However, that 100% level, however, that 100% level is going to be based upon whatever you're selecting, whether it be the annuity or whether it be the lump sum. So if you're thinking about taking the lump sum, interest rates become a factor as well. You may be aging out of the penalty, but you could be severely losing due to interest rates rising. That's what we'll go over here in just a moment. So we've had some severe interest rate increases here for the first part of 2022, and there's no signs of it stopping right now. And one of the good benefits of Chevron is they actually update their pension calculation rates on a monthly basis, so you have a little bit more flexibility and when you can decide to retire. A lot of other companies do it quarterly or maybe once per year, so there's less flexibility there. But what they do is they go back and they look at the third, fourth, and fifth prior month average in order to determine what your interest rate calculation is going to be for the month that you decide to commence your benefits. If we take a quick look at that seesaw at the top, I mentioned earlier about interest rates rising and costing you your lump sum. So they have an inverse relationship. When interest rates go down, your lump sum is going to go up, and that's what happened during the pandemic. Now on that flip side, where interest rates are going up and driving down that lump sum value, the difference here is we're seeing the biggest interest rate jumps we've ever seen from month to month, which means we're seeing the largest drops in lump sum values from month to month. Good news is they're coming off of the highs, so they're still pretty healthy lump sums, but bad news is if we continue to do this, you'll be seeing your lump sum eroded over time. So if you're thinking about retiring here in the near future, in the next year or two, it's really important to give us a call to run these numbers and see how they affect you, because depending upon what your income is, how much your lump sum is, you effectively could be working for free if you stay on a little bit longer. So let's take a quicker look at these. Before I zoom in, just to remind you what those interest rates are. So they take that $3,000 example I gave you and assume, let's say that life expectancy is 86 and you're, let's say 60 years old. So that's 26 more years of potential payments they have to pay you. Then they go out and look at what the interest rates are and do a net present value calculation to determine how much of a lump sum they have to give you. So when those interest rates are lower, they have to give you more for you to go out and recreate that income essentially. And the way they do is they don't look at just one interest rate. They look at 3 different segment rates, which are based upon the Pension Protection Act segment rates. The first segment is going to be for the first 5 years of retirement, second segment for years 6 through 20, and the third segment for years 21 and beyond. So for most of us, that second segment is going to capture 15 years, going to be the bulk of our retirement, so it's going to have a higher weighting. And then also that first segment with those that first 5 years has a significant weighting as well. Let me zoom in on this because it's a little bit small here to show you where the interest rates have been and where they're going. So again, if we look at the first bold line, or actually April, March, and February were used to calculate July. So we go from left to right. July is actually going to be at 2.44%, 3.76%, and 3.94%. If you look at right now, we're in May, so almost wrapping up May. It's actually 1.48%, 3.03%, and 3.39%. And in June, it jumps up to 1.91, 3.36, and 3.67. So the significant thing in there is take a look at that second segment going from 3.03% up to 3.36, then up to 3.76. So that is actually That is actually moving up about 30 basis points and then 40 basis points. So generally speaking, what happens when we have a 1% change in interest rates, it's going to equate to anywhere from an 8 to a 12% change in your lump sum, depending upon your age. So a quick rule of thumb would be 1% equals 10%. So that 3.03 going up to 3.76, that's what, 73 basis points. So you're seeing a 7% drop in your lump sum just from May to July. Obviously, you can't commence previously, but we have the first part of the year in there just for reference. We see in March it was actually at 2.79%. So it's come up. If you look at from March through July, it's come up about 1%. So again, about a 10% drop. We go all the way back to December of 2020 was the low point at two and I think 2.25 is what it was. So we've come up, if we go forward to July, we've come up about 1.5 percentage points. So about a 15% drop from probably where you saw one of your highs. So again, anybody that's looking at retiring in the near future and they're thinking about taking a lump sum, give us a call to run through this because it's very important to understand how much you could be losing versus how much you're making. However, again, if you're taking the annuity, the interest rates don't have an effect on that besides just the purchasing power associated with it. But ultimately speaking, the best thing to do is going to be looking at planning and running that cash flow analysis we talked about before. So just give us a call at 1-800-900-5867. We'll be more than happy to answer any questions you have and run that cash flow analysis as well. So you can see what the lump sum versus annuity looks like at different dates to look at all the different claiming strategies that you have with Chevron. And if you have any other questions, you can always schedule an appointment or reach us at info@theretirementgroup.com. Also, we got a couple QR codes up there for your cell phone if you want to set a meeting with myself or one of the other advisors in the office, or if you want to follow us on LinkedIn and get updated information specifically related to Chevron. We'll give you the updates on new webinars and also keep you updated on interest rates. So I know we went through some of that quickly. I want to get through some of these questions that came through. And I do apologize. I don't have the glasses on, but let me go through these. If I leave, okay, sorry about that. If I leave and lock in lump sum, is it possible to calculate the amount needed to earn part-time job at a golf course to make up for what I would lose if I stayed at Chevron? That's you're talking. Look, you're talking my my kind of speed. Yeah. So ultimately speaking, what's going to happen is let me make sure I can understand the lock-in. So if you leave Chevron and look at taking the lump sum, I guess you're talking about locking in by taking it and rolling it to an IRA because you may not need it or you may only need part of it. But if you were to leave Chevron and not elect the lump sum, I would advise against that right now because again, you may have some age penalties that you defer out of, but the interest rates are rising. So that will actually knock down that lump sum over time. So I think the example would be, let's say let me go back to the rates too. That 1% change I mentioned. So if you have, let's say, $1 million lump sum right now, and those rates went up from May to July, that's 70 basis points, that's costing you about $70,000. If you have a lower lump sum, it's a little bit less, but it's still good money. If you have a higher lump sum, it's even more. So let's assume that individual wants to lock in their $1 million lump sum because they don't want to see that go down by 70,000. They think they've got enough money to retire on, but they want to go out and work a part-time job for either extra money or just enjoyment at the golf course. But we can run that cash flow analysis to show you this and back into those numbers. So we can run it a couple of different ways. So what we like to do first of all is run it and assume you don't do that part-time job and just see if you can sustain a full retirement. But if that doesn't happen, we can back into what do you need to achieve or how much income do you need for the next 2 or 3 or 4 or 5 years in order to bridge that gap. And that's where that part-time job could come in. And I might unfortunately tell you that, hey, I would prefer to work at the golf course if I were you too, but maybe it just doesn't pay enough. But we can run that cash flow analysis to truly show you what those options are. So great question. I enjoyed that. Can you explain Social Security offset? So we mentioned it briefly when I talked about the pension calculation, but what happens is while you're an employee, you're making half of your Social Security tax payments and Chevron's making the other half. So when they run that calculation, they actually subtract back out what they've paid in there to claw that back. So whenever you go through the calculation, it's going to look at your final average pay and your years of service. And then they're going to also do a same multiplier for Social Security offset and pull that out. And one unique thing is that they tend to just use what your income is at Chevron to show you what that Social Security offset is. We have worked with quite a few people who maybe left Chevron early or they started later in their career and maybe they were working as a school teacher or something, or maybe came from overseas. So if you don't have, your entire career at Chevron, there's a chance they might have a mistake and have a higher Social Security offset than what you really need. So if you think this is something that involves you, give us a call. We can capture a statement, a Social Security statement from you, compare that to the pension projection that you run at Chevron. And if your Social Security statement is lower, we can actually submit that to Chevron and get you a higher income annuity or a higher lump sum. And we've done this in the past where it's bumped up, lump sums by, $15,000 to $30,000 and sometimes more. So again, very good question. If you didn't work at Chevron your entire career, it's worth at least looking at that Social Security offset. Okay, I'm confused. My coworker has a larger lump sum than me, and we both have the same years of service and the same income. I'm 8 years older. Is this correct, or is this right? Yeah. So unfortunately, it's not all apples to apples with that example you gave. The age is a big factor on there. So again, I mentioned before I think I gave you an example of somebody who's 60 with life expectancy of 86. So they got 26 years to live. Well, let's assume that person was 8 years older. So instead of 26 years to live, they've got 18 years to live. So they have the same annuity and everything, but when Chevron goes out and does that calculation, they look at, okay, there's only 18 years left for this one person. We look at the net present value calculation of that, and that gives us a certain lump sum. The other person's got 26 years left to live, so they got more payments, and we're on the hook for more. We run the net present value calculation on that, so it comes out more. So that's the difference there. If everything was the exact same, same final average pay, same age, same years of service and everything, it should be pretty much neck and neck. But that change in age is an issue. Now, also depending upon if you were under 60, there could be differences in age penalties. But generally speaking, once you hit that age 60 and everything else held the same on lump sums, you'll start to see a small decline because you're getting closer and closer to that date of death for the calculation. So there's less years of payment to run that calculation, which is why that lump sum goes down. Okay, where are the rates headed at Chevron? Do the federal government rates affect Chevron rates? So I wish I could say specifically where the rates are headed, but yes, the inflation, the federal government rates and everything have somewhat of a tie. Ultimately speaking, we're looking at corporate bond rates and yields with the PPA segment rates on the short, mid, and long term. So if we were to go back to that chart, you'll see that the short term, the first and second segment have jumped up higher than what that long term segment has, because again, a lot of the short term inflation, a lot of the short term Fed hikes and stuff. But it's not a apples to apples comparison, but it does have an effect there. And unfortunately, we just got out the April, and looks like that trend is continuing. So I would think that we're probably still going to see rates continue to go up here, at least for the rest of the year, maybe level off here closer to 2023. But even if rates flattened out right here, you're still going to see a bump up in your interest rates used for August and September, because again, it's a rolling average. We're looking at those 3 months. So those lower months will drop off, and then we'll be looking at averages based upon essentially just April. We'll give that to you. So again, give us a call more specifically, because we need to tie that into what your picture is. If you're thinking about retiring in 3 or 4 or 5 years, it may not be an issue. If you're thinking about retiring, especially this year, maybe into next year, it's definitely a concern and something to look at if you're thinking about taking the lump sum. Okay, how does inflation impact my lump sum interest rates at Chevron? I think we've kind of gone through this a little bit, but again, those inflation is a factor that's driving these interest rates, the Pension Protection Act segment rates, and as those rates go up, that's going to drive down your lump sum calculation. So again, when interest rates go up, which they are happening right now, it's going to drive down your lump sum. The question is, how much do they go up by, and how quickly do they go up by as well? And then the other aspect of that is it also has an effect on your annuity as well. We're talking a lot about the lump sum here, which a lot of people have been taking recently. But if you take that annuity, I go back to that $3,000 example I gave before, that $3,000 is not going to buy the same thing in 5, 10, 15, 20, 30 years down the road. So the more inflation we have, you're eroding your purchasing power on that as well. So that's why it's important to look at this side by side and those choices. And keep in mind, you also can take advantage of the lump sum and possibly do your own partial annuity if you want to, and have a little bit more flexibility on that side as well. But all things to review one-on-one. And I think I've got one more here. Let me see. When do the rates at Chevron get adjusted? So again, I think I may have gone through most of this, but they're going to be adjusted on a monthly basis. They're looking at the average of the third, fourth, and fifth prior month in order to get that monthly average. So again, we just got the April rates out, which gave us the rates for July. We won't get the next ones out. Usually the Fed releases them about the third week, somewhere around like the 20th or so of the following month. So we'll wait till around June 20th. We'll get the rates for May, and that will tell us what the next monthly jump is. But ultimately, the best way on that screen, again, go ahead and hold up that QR code and follow us on LinkedIn. If you have concerns about that, we'll be happy to provide you with the updated rates every month as those come through. So I know we covered a lot of questions there and a little bit of information on the rates, but ultimately the question is, or the answer is, if you have questions, give us a call and either run or update that cash flow analysis so you can see the big picture and how this all affects you. But you can always reach us at 1-800-900-5867. And again, we've done a lot of extensive work with Chevron employees who have a deep understanding of this process. But at the end of the day, we're not employed by nor are we affiliated with Chevron. So again, any questions, 800-900-5867. And I hope everybody has a great day.